Our next guest isn't buying. Citigroup, that is. Matthew McCormick is a portfolio manager and banking analyst at Bahl Gaynor, which has about $3.6 billion in assets. He sold his big U.S. bank stock holdings in 2007 and isn't quite ready to dip his toe back into the water. Matthew was on the phone from Cincinnati, Ohio. So, Matthew, Citigroup out at 8 o'clock this morning. What, if anything, would it take to get you back into Citigroup shares?
Good morning, Eric. I think in order for me to see them, for us to have more interest, is we'd have to see a bigger and more sustainable dividend before we would feel opportunistic about entering Citigroup, but I don't think that's going to happen anytime soon. I think when you look at Citigroup, I give Pandit some credit. He's had a very, very difficult job, one that few people would want in terms of keeping Citigroup going. But I think really what people are going to focus on is the weakness in earnings, the weakness in revenues, the impact in Asia, particularly what's happening in terms of investment banking and trading. I do not have high expectations for them to beat on the earnings or revenue side, and I expect continued weakness going forward.
Why is it that you're so skeptical of their earnings power in the trading business? Because, as you know, trading was a big question mark for both JPMorgan and Bank of America last week, yet both surprised, you might say, quite nicely with results in the trading business.
I think trading and revenue, I'm kind of combining them right now, and I think when you look at what's happened in terms of the Middle East and Japan and the volatility that we saw next year, I think it's going to impact investment banking revenues more than people think.
Matthew, you mentioned the dividend and the need to see more of one from Citigroup before you're tempted back into that stock. Does that mean we're going to see a bifurcation develop in this industry with banks like JPMorgan, which have gotten the go-ahead from the Fed to pay dividends and to continue aggressive stock buybacks, and those like B of A and Citigroup, which seem to be some ways from getting there?
That's a great point, Eric. I think that is the divide between the haves and the have-nots will continue, and the dividend is the clear differentiator. You have to almost have it from an investment standpoint. You could say one is increasing their dividend or one has a substantial yield and one does not. And it shows that one is further down the path of repairing themselves and their balance sheets in their participation with shareholders in terms of being more shareholder friendly. It gives a stronger sign of financial health. I think the reverse split is something that shows that it's somewhat of a gimmick. I think when you look at Citigroup going forward, I have more questions than answers, and that's the reason why we're not owning it at this time.
Now, but why not own JPMorgan, for example, if dividends are what's appealing? You know, I mean, the stock tells the story itself. JPMorgan is down 6% in the past year, and this is supposed to be an attractive bank.
Sure. We look at it as alternatives. Right now you have JPMorgan that has roughly a 2% yield. We own several Canadian banks that have 3% and 4% yield that never cut their dividends, that have a much stronger economic footprint with no subprime or Alt-A. So it's nothing against JPMorgan. I like their yield. I applaud it, but I want to see them come out and increase it over a sustainable period of time. And Jamie Dimon said he has several quarters before he's going to do that. So I'd rather own a company like Bank of Nova Scotia that has a 3.1 yield. It just increased its yield 6% about a month ago, and it's going to do it another 6% before year's out.
Matthew, thanks for joining us. Matthew McCormick, a portfolio manager and banking analyst at Bahl Gaynor, says he's not interested in any of the big U.S. banks. He, too, is a fan of those Canadian banks.